In March 2023, Silicon Valley Bank collapsed in 48 hours. Not because of fraud, not because of a recession, because the people with enough money to move fast moved fast. In a single day, depositors pulled $42 billion out of the bank. The ones who stayed were the ones who did not know they could leave. That gap between the people who understood how the system worked and the people who assumed it worked for everyone equally is not unique to that bank. It runs through every branch, every savings account, every loan application in the country right now. Here's what most people assume. If you pay your bills, keep a decent credit score, and stay out of debt, the bank treats you like a valued customer. That assumption is costing you money every single month. Banks sort their customers quietly, automatically, without telling you. There is a tier for people the system extracts from, and a separate tier for people it actively competes to keep. And the number that separates those two tiers is $25,000 in liquid savings. Because that is the exact threshold where the bank's internal underwriting algorithms reclassify who you are. Below it, you are a predictable revenue source. Above it, you become a retention problem. That shift changes your loan rates, your fees, and your negotiating position, whether you know it is happening or not. My name is Alex, and if you have ever felt like other people are getting better rates and better terms for no obvious reason, stay with this. Because there is a reason, and I'm going to show you the 5 internal shifts that happen the moment you cross this line, and exactly what it takes to get there. Once you understand how banks actually categorize you, you will never look at your savings balance the same way again. It starts with the first shift, and it happens inside the underwriting algorithm before you ever sit down with a loan officer. Most people think a credit score is the whole game. Get to 740, 760, maybe 800 if you are really disciplined, and the bank rolls out the red carpet. That is the number everyone obsesses over. But there is a second number that banks weigh just as heavily, and almost nobody talks about it. When your liquid savings cross $25,000, something happens inside the bank's systems before you ever fill out a loan application. You get reclassified, not by a person, by an algorithm. And that reclassification changes the rate you are offered, the terms you qualify for, and how much risk the bank decides you actually represent. Here is why that number specifically. $25,000 covers roughly 6 to 9 months of a median American's core expenses. Mortgage or rent, car payment, utilities, the non-negotiable monthly stack. That means if you lose your job tomorrow, you can keep paying your obligations for the better part of a year without missing a single payment. Banks know this. Their statistical models know this. And because of that buffer, their systems classify you as 40% less likely to default on a loan during a recession compared to someone sitting on $5,000. You stop being a standard risk. You become what lenders call a resilience threshold borrower, someone whose savings act as a private insurance policy against the bank's downside. Now think about what that actually means in dollar terms on a loan you are probably going to take out anyway. A $30,000 auto loan is a good place to run the math. Currently, the average new car loan rate sits at around 7% for a standard borrower. But for a borrower whose liquid reserves push them across the resilience threshold, rates for prime borrowers drop closer to 4.66%. That difference, roughly 2.5 points, saves you about $1,600 over a 5-year loan, not because your credit score changed, not because you negotiated harder, because an algorithm looked at your savings balance and decided you were a different category of person. $1,600. That is 2 months of car payments, handed back to you before you drove off the lot. And most people never knew to ask for it. But here's the part that should bother you. Most people never get to use this leverage, even when they have earned it. Think about a guy in his mid-30s who works in project management, makes a solid income, spent 3 years being genuinely disciplined about saving. He finally hits $25,000. Feels good. Decides this is the moment to buy a house. So he pulls $20,000 of it for the down payment, feels responsible, and walks into the mortgage application with $5,000 left in his account. The exact moment he takes on the largest debt of his life, he voluntarily drops himself back into the high-risk category. The algorithm sees $5,000 and reprices him accordingly. He just surrendered his leverage at the worst possible moment. This is not a rare mistake. It is the most common one. The goal feels like the down payment, but the down payment is the trap. The $25,000 was never meant to be spent. It is the tool that changes how every future financial transaction gets priced for you. Your credit score tells the bank your history. Your liquid savings tell your future. Banks care about both. And right now, the system is quietly charging most people extra because they have only focused on one, which brings up the next layer of this. Because while the algorithm shift changes what you pay on loans, there is a completely separate mechanism bleeding money from your account every single month. And it has nothing to do with borrowing. It is built into the fee extraction loop that retail banking runs on. And it is designed to be invisible until you know exactly where to look. Nobody sits down and decides to pay the bank a loyalty tax. But that is exactly what is happening to the majority of Americans with a standard checking account. Quietly, automatically, every single month. Retail banking is a volume business. Banks make money by managing enormous numbers of small accounts, and the fee structure built around those accounts is not accidental. It is engineered. Monthly maintenance fees, overdraft charges, out-of-network ATM costs, these are not administrative nuisances. They are a revenue model, and they are almost entirely concentrated on accounts below a certain balance threshold. Here is how the math looks right now. The average monthly maintenance fee at a major traditional bank currently sits at $13.51. That is $162 a year, taken directly from people who are already trying to save. The average overdraft fee runs $32 per incident. One accidental timing error between a direct deposit and an automatic bill payment, and that is $32 gone. Not to cover a loss, not to fund anything useful, just because the balance dipped below zero for a few hours. And here's the part that rarely gets said out loud. Nearly a third of checking accounts charge no monthly fee at all. The fee-free option exists. The bank is simply not going to tell you about it unprompted, because for every customer who never asks, that $162 a year is pure profit. Cross $25,000 in liquid savings, and the math inverts completely. At that balance tier, you move into what banks internally call the premier relationship level. The monthly fee disappears. An accidental overdraft gets waived with a phone call. Wire transfer fees, out-of-network ATM charges, reimbursed or eliminated. Not because the bank suddenly became generous, because at this level, you represent enough deposited capital that losing you to a competitor is more expensive than absorbing the occasional fee. That is the real mechanism. It is not loyalty, it is leverage. Consider a nurse in her early 40s, careful with money, who never misses a payment, has had the same checking account for 11 years. She pays $14 a month in maintenance fees without thinking about it. Hits an overdraft twice a year, maybe 3 times. Each one costs her $32. She also uses an out-of-network ATM a handful of times, another $4 to $5 each time. Added up across a year, and she is quietly handing the bank somewhere between $300 and $400 annually. Not in interest, not on debt, just in penalties for not having enough of a balance to qualify for the tier where those charges stop existing. That is what the original research calls the inertia tax. The fee is small enough that canceling feels like more trouble than it is worth. So it continues, month after month, year after year, and the bank counts on exactly that psychology when it designs the fee schedule. Now, the important point, the bank is never going to invite you to upgrade. That would mean voluntarily giving up guaranteed revenue. The move to the premier tier only happens when you force it, when your balance gives you the standing to demand it. Until then, you are subsidizing the bank's operating costs with money you earned. And look, the fees are frustrating enough on their own, but they are actually the smaller problem. Because once you understand what the bank earns on the spread between what it pays you to hold your money versus what it charges to lend it out, the fee conversation starts to feel like a distraction from something much larger. That gap between what your savings actually earn and what they should be earning is what the net interest margin calculation reveals, and the numbers are genuinely difficult to ignore once you run them. There is a number your bank hopes you never actually calculate, not because it is hidden exactly, because it is boring enough that most people never bother, and that boredom is worth real money, just not to you. Here's the core of how banking profit actually works. A bank takes your deposited money and lends it out. The spread between what it pays you to hold your cash and what it charges someone else to borrow it is called the net interest margin. That margin is the engine of the entire retail banking business model. And right now, that engine is running almost entirely on your inertia. The national average interest rate on a standard savings account is currently 0.38% annually. That is the rate the overwhelming majority of Americans are earning on their savings today. On the other side of that equation, the average credit card interest rate sits at around 21%. The bank collects 21% from borrowers and pays depositors less than half of 1%. That spread, that gap between what goes out and what comes in, is not a coincidence. It is the business model. Now run the math on what that actually costs you at different balance levels. If you have $2,000 sitting in a standard savings account at 0.38%, you are earning about $7.60 a year. A high-yield savings account at a competitive online bank currently pays around 4% annually. The same $2,000 there earns $80. The difference is $72. Not nothing, but not enough to change behavior. Most people do the mental math, shrug, and leave the money where it is, which is exactly what the bank is counting on. Cross $25,000, and the same calculation produces a completely different result. $25,000 at 0.38% earns $95 a year. The same balance at 4% earns $1,000. The gap between those two outcomes is $905 annually. That is not a rounding error. That is a mortgage payment, a car insurance bill for the year, a family vacation that did not happen because the money was sitting in the wrong account, doing almost nothing. And here is what actually shifts at that threshold. It is not just the math, it is the psychology. When the difference between a standard account and a high-yield account is $72, apathy wins. The friction of switching feels roughly equal to the reward. But when that same decision is worth $905 a year, something changes in how you see the account. You stop thinking of it as a place to park money. You start thinking of it as a decision with consequences. Banks understand this threshold better than their customers do. That is why the moment your balance approaches the $25,000 mark, something interesting tends to happen. Promotional CD rates appear in your banking app. Special new money bonuses show up in your inbox. Relationship banker might even call. The bank is not doing this out of generosity. It is doing it because its own models flagged you as a flight risk. You have reached the balance level where a competitor's 4% offer is no longer easy to dismiss. The bank is racing to lock in your money before you realize you have options. That moment, when the bank starts competing for you instead of just charging you, is worth paying attention to, because it is a signal. It tells you exactly where your leverage begins. But leverage over your savings rate is only one piece of it. The more interesting power shift happens when you walk into a branch with a specific problem, a fee to dispute, a rate to negotiate, a term to push back on. Because what happens in that conversation depends almost entirely on what your account balance says about you before you open your mouth. That is what the negotiation surface actually looks like. And the difference between the two versions of that conversation is sharper than most people expect. Picture two people walking into the same bank branch on the same morning to dispute the same $32 overdraft fee. Same bank, same fee. Completely different conversations. The first person is a freelance photographer in her early 30s, solid work history, pays her bills, and has about $800 in her checking account. She waits in line, explains the situation calmly, and asks if the fee can be waived. The representative is polite, apologetic even, but the answer is no. The system shows no prior waivers, the account balance does not meet the threshold for automatic forgiveness, and the fee stands. She leaves with $32 gone, and a vague sense that the rules are fixed. The second person is a contractor in his mid-40s with $26,000 sitting across two accounts at the same bank. Same overdraft, same $32. He makes the same request. Before he finishes the sentence, the representative has already pulled up his account profile. An internal flag has marked him as a high-value relationship. The branch has quarterly deposit retention targets to hit. The fee disappears in about 90 seconds. He is also offered a rate review on his savings account before he leaves. Same bank, same fee, same day. Two entirely different outcomes, determined entirely by what the account balance communicated before either person said a word. This is not a policy written down anywhere. It is a function of how bank branch economics actually work. Representatives have discretionary authority to waive fees and adjust terms for customers the system identifies as worth retaining. That discretion does not get exercised equally. It gets exercised in the direction of the customers. The bank cannot afford to lose. Below the threshold, you are easily replaced. Above it, your exit has a cost. And this dynamic scales well beyond fee disputes. Interest rate negotiation, loan term flexibility, early withdrawal penalties on certificates of deposit. All of it becomes more negotiable the moment your balance signals that you have options. The bank knows you could move that money. That possibility is what creates the opening. Here is where the stakes get genuinely large. In March 2023, Silicon Valley Bank collapsed in under 48 hours. Depositors pulled $42 billion out of the bank in a single day. What is worth understanding about that run is not just the scale, it is who drove it. The accounts that moved were not small retail depositors with a few $100s in checking. They were businesses, founders, and individuals with enough capital and enough financial awareness to recognize the risk and act on it immediately. The top depositors at Silicon Valley Bank alone held 39% of total deposits. At First Republic, 50%. These were people who understood that cash is mobile, and they used that mobility when it mattered. The lesson banks took from that episode was not to become more stable. It was to exit harder. Digital banking interfaces were quietly redesigned with additional verification steps and security pauses. Friction was added to large transfer flows. The goal was not consumer protection, it was capital retention. They made the door heavier so fewer people would walk through it quickly. That is worth sitting with for a moment. The bank is not neutral. It has a structural interest in keeping you slightly confused about your options and slightly inconvenienced when you try to act on them. Knowing that changes how you read every policy, every interface, every hold time. The negotiation surface is real. The leverage is real. But both of them only exist if you recognize something more fundamental first, that your relationship with the bank is not what most people assume it is. Because the final shift that happens at $25,000 is not about fees or rates or negotiating tactics. It is about how you understand your own position in the system. That is what identity reclassification actually means, and it reframes everything that came before it. Here's a question worth sitting with. At what point does a person stop being a bank customer and start being a bank creditor? Most people never ask it. The relationship feels one-directional. The bank holds your money, provides a service, charges some fees, and that is the arrangement. But that framing is exactly backwards. When you deposit money into a bank, you are not storing it somewhere safe. You are lending it to the bank. The bank takes your capital, lends it to other people at 21%, and pays you back less than half of 1% for the privilege of using it. You are the supplier. They are the manufacturer. And for most of your financial life, you have been acting like you should be grateful for the relationship. That mental model, customer, not creditor, is what keeps most people on the wrong side of every financial interaction they have with their bank. And it does not shift until the balance does. The median savings balance for Americans between 35 and 44 years old is currently $4,710. That is the middle of the demographic most likely to be watching this. $4,710. Not because those people are irresponsible, not because they are spending carelessly, but because the entire consumer economy is structurally more comfortable when they stay there. An HVAC system breaks and goes on a credit card at 21%. A medical bill arrives and becomes a payment plan with fees attached. A car needs replacing, and the dealer's financing desk handles it. Every one of those moments is a transaction that only happens because there was not enough of a cash buffer to make it unnecessary. The bank does not create those moments, but it is very well positioned to profit from each one. Cross $25,000, and the architecture of those moments changes. The HVAC repair gets paid in cash. The medical bill gets negotiated down because you're not desperate. The car gets financed on your terms, or not financed at all. Every one of those outcomes represents money that the financial system did not get to extract from you. Each dollar sitting in that buffer is a dollar that cannot be converted into interest income for someone else. That is not a small thing. That is the mechanism by which financial pressure is either maintained or broken. This is what the research means by identity reclassification. It is not just that your loan rate improves or your fees disappear. It is that you stop evaluating financial decisions based on what you can afford monthly and start evaluating them based on what the transaction actually costs in total. That shift in thinking, from payment to price, is the real marker of the threshold. It changes which questions you ask. It changes which offers you accept. It changes whether you walk into a negotiation or get walked through one. Think about a teacher in her late 30s who spent 4 years building her savings to $26,000. She does not feel rich. The number does not look dramatic on a screen. But the next time her landlord raises the rent, she has the option to move without panic. The next time a financial decision needs to be made quickly, she can make it from stillness instead of urgency. That is not a personality trait. That is a direct consequence of the balance. Calm is a financial product. It just does not get sold that way. Here is the practical question that follows from all of this. Knowing that $25,000 changes your position in the system, how do you actually get there? And more importantly, how do you stay there once you do? Because the biggest risk is not failing to reach the threshold. It is reaching it and immediately spending it back down. The roadmap for avoiding that mistake is straightforward, and it starts with 4 specific steps that anyone can begin this week. Knowing the threshold exists is one thing. Actually getting there and staying there is where most people quietly fall apart, not because they lack discipline, because they lack a specific sequence. And sequence matters more than motivation every single time. The research is detailed on one point. Reaching $25,000 in liquid savings is achievable for a regular income earner within 3 to 5 years of focused effort. That is not a guarantee, and it is not a pitch. It is a function of redirecting money that is currently leaking out of your financial life through fees, lost yield, and avoidable interest. The exact mechanisms this video has been unpacking. The money is often already there. It is just flowing in the wrong direction. So here is the practical roadmap. 4 steps, not a budget overhaul, not a lifestyle change. 4 specific redirections that change the math without requiring a different income. Step 1 is the fee audit. This week, not eventually. Pull up your last 3 bank statements and add up every maintenance fee, overdraft charge, and out-of-network ATM cost. For most people at a traditional bank, that number lands somewhere between $200 and $400 a year. Then open a fee-free checking account at an online bank or credit union. The national average monthly maintenance fee currently sits at $13.51. That is $162 a year you can recover in about 20 minutes of admin work. It is not dramatic. It is just math. Step 2 is yield capture. If you have $10,000 sitting in a standard savings account, earning the national average of 0.38%, you're earning $38 a year. The same $10,000 in a competitive high-yield savings account, currently earning around 4%, generates $400. The gap is $362 annually, and closing it requires one account transfer, not an investment strategy, not market timing. One transfer. Do it before the end of the week. Step 3 is using cash as a credit signal. The next time you apply for any loan, auto, personal, mortgage, do not wait for the lender to notice your liquid reserves. Name them explicitly. Tell the loan officer your available cash balance before they run the numbers. Banks weigh liquid asset to debt ratios heavily in their underwriting models, and most borrowers never surface that information proactively. The ones who do get repriced. Think about a marketing director in his early 40s applying for a car loan. Same credit score as the person ahead of him in line. He mentions his savings balance up front. The rate he is offered comes in almost 2 full points lower. That difference over a 5-year loan is real money, and it was always available to him. He just had to say the number out loud. Step 4 is the threshold hold. This is the one that undoes everything if you get it wrong. When you finally reach $25,000, do not spend it. Not on a down payment, not on a renovation, not on anything that drops you back below the line. The $25,000 is not the destination. It is the tool. It is what changes your loan rates, eliminates your fees, and gives you standing in every financial negotiation you will have for the rest of your life. The moment you treat it as a reward, you give all of that back. Spend below the threshold, invest above it. Keep the buffer intact and let it work as the mechanism it is, not a number on a screen, but a permanent shift in how the entire system prices you, which raises the question of where exactly you hold that $25,000, because keeping it all in one place, one bank, one account, creates a different kind of vulnerability. The strategy for structuring it correctly across institutions has a name. It is called the 3-bank system, and it is what separates people who reach the threshold from those who actually use it. Here is what this all comes down to. The financial system is not designed against you, it is designed around you, around the assumption that you will stay below the threshold, stay inert, and keep generating steady, predictable revenue for the institutions holding your money. That is not cynicism, that is just the business model. What changes at $25,000 is not your income, not your credit score, not your discipline. What changes in your position? Below the line, the system extracts. Above it, the system competes. And the distance between those two experiences is not measured in lifestyle. It is measured in loan rates, lost yield, and every fee that quietly disappeared the moment you became too expensive to lose. A few things are worth carrying forward. Liquid savings and credit score are weighted equally by lenders. Most people only manage one. The fee you are paying right now exists because the bank calculated you would not leave. The spread between what your money earns and what the bank charges to lend it is the most important number in your financial life that nobody ever shows you. Watch for the moment a bank starts competing for your deposits. That is not customer service. That is the signal that you have crossed the line. The natural question that follows is where exactly you keep $25,000 once you have it, because holding it all in one place creates its own set of problems. That is a different conversation, and it is worth having.